It doesn't surprise me. You know what my feeling is that the financial service industry in the U.S. treats gold like kryptonite. And one of the main reasons they do is they can't churn it, burn it, and make a lot of money in a lot of different ways. And it also flies in the face where they do make a lot of money, and that's in stocks and bonds. And here we are making high after high, and you can hear a pin drop before you'll hear somebody in the regular financial networks talking about gold.
If you invested in gold and the S&P 500 from 2000 to the mid-2020s, you would have had better returns with gold. Gold shines brightest during periods of market stress or inflationary spikes. From 2000 to the mid-2020s, gold investments multiplied ninefold, outpacing the S&P 500's sixfold increase. Recent history also underscores gold's role as a crisis barometer. It hit historic highs of $2,089 per ounce during the pandemic and surged to records again amid geopolitical tensions in 2024. Global expert Peter Grandich warns that if gold rises too quickly, like a bottle rocket, it risks sharp pullbacks and volatility. However, Grandich states gold hitting $3,000 but favors a brief 2 to 5% pullback for a healthier climb. He notes that despite gold outperforming stocks and bonds, financial advisors and institutions largely ignore it, with most portfolios still dominated by traditional assets. Based on current trends, Grandich expected a quiet start for gold in 2025, but Trump-related events accelerated its rise. He cites two key factors, including central banks hoarding gold ahead of a financial reckoning and Asia's growing dominance in physical gold trading, which is weakening Western paper manipulation. The recent expansion of BRICS countries, including Argentina, Egypt, and Iran, has intensified discussions around de-dollarization. The bloc now controls approximately 42% of global central bank foreign exchange reserves, which positions it well to promote local currencies in trade. According to Grandich, the recent tariff situation further disrupted market manipulation, reinforcing a shift toward a real physical gold market. On February 1st, President Trump imposed tariffs on the United States' three top trading partners, Canada, Mexico, and China. Those 25% tariffs on goods imported from Canada and Mexico and the 10% tariffs on imports from China could cause higher inflation and a slowdown in economic growth, which may lead some investors to gravitate toward the perceived safety of gold. Now, we present the clips of Peter Grandich's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Back at the end of 2021, I made a decision for myself and didn't think really much of our clientele and our planning group should do the same, but consider it partly. And that was that I actually thought through the end of 2024, gold would actually outperform both stocks and bonds. Some people bought the stocks part. They just couldn't imagine how could it beat bonds. Bonds are always the safe investment. Well, bonds up having two, they're in the third year. Losses at this point in time. And when we began this year, I even said I still believing that 3,000 was coming, but I thought, the first few months may be a little quiet in gold, but that changed. And it changed a lot because of Trump. So as much as you say that it was a short period of few days of profit taking, some of the actions of Trump have led to the two things that that I've spoken about these last few years, which are the two single most bullish factors for gold. One, central banks are acquiring it like there's no tomorrow. And I believe because they recognize a day of reckoning will come, partly because of what's happening with BRICS and the fact that one day with all this debt in the world, there's going to have to be some sort of restructuring, and that gold proved to be worthy for something like that for a couple thousand years. And they weren't buying into the crypto nuts that somehow it's a real relic and crypto is going to save the day. So central banks have been extremely aggressive buyers. But the other part that you and I spoke about, which is now playing out, is I mentioned to you several times how the movement of physical trading from London and New York, which some of us like to call the Crimex, not the Comex, and to Asia was going to seriously impair the paper hangers who tend to play the short side aggressively in the paper market in gold out of London and New York. And when we did have those one day down $30, $35, I would get online and tell everybody, listen, it doesn't last like it used to. Probably as early as tomorrow or no more than a few days from now, we'll be back above wherever they sold it from. And that's what's happened. And now the tariff situation, where really concerns of potentially making deliveries came into effect, it was the 1-2 punch. And it really radically changed now this game, because irregardless of how they try to fix it or whatever, the old games are gone. They're not going to be able to play it in that way anymore. And I think a real physical market will dominate over the paper market. And that's nothing that we've seen for the 40 years that I've been in this business, but that is a huge change that's occurring. So those are the two things. Now, as you and I speak here on this Friday before the Super Bowl weekend, we are overextended and we could still rally right to 3,000. But if you're someone that's looking for a much higher number, it would actually better now that if it just takes a little breather, corrects a little, 2 to 5% type corrections are okay in this type of bull run. And 3,000 is just a round number. It's not a number that should offer, some special type of resistance, but it'd be better that we go through it when we're not as deeply overbought as we are now. Gold shouldn't do anything. I'm just saying it would be actually better if you had a long-term perspective. Because what happens is the more a market gets overextended, or in a sense looks like a little like a bottle rocket and all, when the fire goes out, it doesn't have anything to fall back on and it falls sharply. And it creates disenchantment because of the volatility. I'm not saying it's gone, although we came off a little bit here Friday going into the weekend. I suspect that we've seen them already raise margin. That didn't really work this week. I don't know what much left they can have, except that if it's as bad as some people written about over the years, government controls would have to be instituted. And, Great Britain would have to look at that in terms of London and so forth. But the good news in all of this is that what it's performed for a couple of thousand years, it has done it yet again. Do you know, when you tell people this, and Elijah, don't be offended by your youth when I say this you're hearing this from an old man, but almost half the financial service industry in America now wasn't even born when I started. And probably well over up to somewhere between a third and a half of all financial advisors only started in the business after the new millennium started. But if you go to most people and say, hey, since the new millennium started for the last 25 years, what's been the best performing? Oh, stocks. They've been killing it. Maybe bonds. You hear the average person say gold. Gold has outperformed both stocks and bonds from January 1st, 2000 till now. And yet ownership of it, yes, people that are watching your show are the small minority that do it. But you and I go into any financial service firm, any hedge fund group and all, and look at any 100 accounts in any part of the country, and maybe 2 or 3 have some exposure to gold, especially physical gold. The rest are loaded with stocks and bonds.
In his analysis, Peter Grandich warns that while deficits may shrink slightly, massive spending will still be required for infrastructure, debt servicing, and a looming retirement crisis. He argues that even if the stock market doesn't crash, its expected underperformance over the next decade will hurt investors relying on high returns. While shifting towards miners, Grandich notes that major gold producers are generating record cash flow as gold prices rise, fueling acquisitions and expansion. He expects this to boost the junior resource market, especially as interest in cryptocurrencies wanes. Smaller mid-tier and junior gold miners were way outperforming their larger peers, often reporting lower and stable AISCs generating massive record unit profits. Newmont hasn't represented this sector for many years, if not decades. On top of that sentiment-tainting Newmont AISC miss, just a few trading days later, gold rolled over into its own overdue sell-off. That scared gold stock traders who sold hard into year-end. Gold revalued way higher last year, reflecting a major paradigm shift in traders' perception of it in this still inflationary economic environment. Gold stocks will follow their mettle this year, reflecting their epic fundamentals. Let's get back to the interview.
Deficits may shrink because instead of spending $3 trillion more a year, they might only have to spend $1 trillion more because they find these $2 trillion that were going out the door the wrong way. But so much money is going to be needed to take care of the things that we spoke about: a crumbling infrastructure, a retirement crisis, an aging crisis, and servicing our debt. Listen, 27 states have financial crisis and they don't have a printing press, and they're not balancing their budgets, and they're all going to look for Uncle Sam for the help and all. So yes, it's good to see these things happening, especially when people were truly ripping us off big time. To see all these payments that were going to the media, and then the media was making these reports only because they're being paid off. Those were the worst visions we had of banana republics. And here we were, the biggest banana of all. But I still think that at the end of the day, the stock market, will underperform. Here's the big point. It may not crash. I notice people talking about crashes. I'm not in that camp at all. But even if it just goes flat, Goldman Sachs is even coming out and saying now that the stock market for the next 10 years is going to underperform. The problem with that is, and I can tell you that firsthand from our planning group, we still meet 7 or 8 out of 10 families at all levels of income who are living and spending more than they're making. And part of the reason is because they've gotten used to above average returns in the market. And so if the market doesn't go down a lot and they lose a lot of principal, if they don't make excess that they can keep living off, then they're going to have an issue. And also, it's not going to be how much you make in the future. It's how much you don't lose, which is going to make the difference of whether you're a winner or a loser. Well, it's happening now on the majors. I mean, the GDX is almost up 20% just in 5 weeks of trading in the new year. And the reason that is these major gold producers, the majors now, not little small explorations hoping to find something on a wing and a prayer, but legitimate major producers that are producing hundreds of thousands of ounces a year, if not 1 million ounces or more. They're cash machines now. Their free cash flow is at records. And we were just 2,600 and something a couple of weeks ago. So another 200 and something to the bottom line. Their operating costs didn't increase same percentage-wise during that time. Their fourth quarter numbers are going to be great, but their first and second quarter numbers here, being able to, even if they started selling gold forward here at near almost 3,000, they're going to be cash machines. And that's what's going to lead them to build their business for the future by going out and buying deposits and potential companies that have good potential into the lower end, or what I like to say where I'm invested heavily in the junior market. That was the last missing ingredient to finally get the junior resource market going. That and the fact that cryptocurrencies still are a big negative to that end of the market, because people will rather speculate on some meme coin with a name fought in it than a prospective junior company that may actually find gold, silver, or copper. And as that changes or lessens, that'll be beneficial for the junior market as well.
Leading Swiss bank UBS remains bullish on gold prices and predicts it's on the way to breaching the $3,000 mark. The leading investment bank forecasts that the glittery metal could reach the threshold in the next 3 months. The bullish divergence stems from the growing demand for gold from retail investors, institutional funds, and central banks. With economic shifts accelerating gold's rise, do you believe gold will continue to outperform in the years ahead? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.